20 million electric vehicles were sold globally in 2025. To many, it looks like a modern gold rush. Swap out gas pumps for charging cables and capture a growing share of the energy market. The intuitive business model is straightforward. An operator buys electricity from the grid at a wholesale rate and sells it to drivers at a retail markup. But applying this one-to-one gas station model to EV charging is a reliable way to lose money. Selling electrons differs from liquid fuel. The costs are structured differently, the customers stay longer, and the most dangerous expenses often happen when no one is even looking. Comparing upfront capital costs, a standard Level 2 charger requires up to $15,000 for hardware and installation. But for commercial DC fast chargers, which add hundreds of miles and minutes, the price jumps upward, exceeding $350,000. Relying purely on the pennies earned from direct charging fees to pay down a six-figure installation creates a 5 to 10-year payback period. To navigate these high capital requirements, operators have to look beyond the simple transaction at the plug and find new ways to generate value. Even after the hardware is in the ground, profit margins face constant threats. The first is poor first-time success rate, or FTR. This measures how often a driver successfully initiates a charge on their first try. When broken hardware forces drivers to abandon a session, the site loses revenue and customer trust. This line graph plots a major threat: utility demand charges. Utilities penalize based on peak power draw. As this red line draws across, a single 15-minute spike dictates the cost penalty for the entire month. If 3 electric vehicles connect to fast chargers at the exact same time, they trigger this spike. Looking at the expense spike down on the right, that 15-minute window wipes out the entire profit margin. Unmanaged demand charges turn a high-traffic charging station from a potential asset into a financial liability. To counter these costs, smart operators secure government grants and tax credits that can subsidize a significant portion of that initial capital investment. Operators also leverage driver behavior. Gas fill-ups take 3 minutes, but EV charging introduces dwell time, the 20 to 40 minutes spent waiting. Operators capture foot traffic. While cars are plugged in, drivers visit nearby cafes, generating substantial indirect revenue. In this model, the charger functions as a traffic driver for a larger retail ecosystem, rather than a standalone power vendor. The most successful operators have realized that long-term profitability comes from managing grid power, not just dispensing it. This flowchart illustrates an advanced strategy: on-site battery energy storage managed by AI. Using energy arbitrage, the system stores electricity at night when rates are low. During daytime peak hours, the grid connection is bypassed. The battery takes over, flattening the demand curve. This allows for peak shaving. By using stored battery power to fill cars during the midday rush, the operator avoids the high utility demand charges that would otherwise kill their margins. Some stations are even testing vehicle-to-grid technology, selling stored power back to the local utility when the grid is under stress to earn additional revenue. The operators that succeed in this transition will be those that manage their sites as dynamic, intelligent virtual power plants.